not a lot of people have been correct in calling the action we've seen. Of course, not a lot of people could have predicted we would have seen a pandemic. But after we did get that news and saw the way it impacted the market, there have been few people more correct this year than Fundstrat's Tom Lee. Want to just spotlight what he's called this year in 2020. Back in the darkest part of the sell-off in March, when everyone was panicking, Tom called for a rebound to 2,800 on the S&P 500 by April and called for all-time highs in just 4 months' time. We hit 2,800 in April as he predicted. He said that confirmed the thesis, and the stock market would be back to the levels we saw before the pandemic, and that also played out. During the September sell-off, he called the line in the sand at 3,200, roughly about that. And sure enough, we bounced off that. And then finally, in the post-election sell-off, he said to keep your eyes on the VIX. If we hit 25, he said that the market would be overlooking those election challenges by President Trump. And sure enough, we did see that play out as well. So I want to bring on the man himself here with us in Fundstrat's Tom Lee here. We'll give the formal title, Fundstrat Global Advisors Managing Partner and Head of Research. And Tom, congrats on the great year, man. I mean, like I said, a few people have been as right as you, and I love your takes because they're all based on data and history. And looking back on the history we've seen play out here, you're looking ahead to 2021, and you're saying the first half of the year might be a tough one for investors to stomach before we bounce back. So what should investors expect next year?
Well, I think that, as we look back in 2020, the world got lucky. And so stocks were able to look past a lot of bad things, but enough good things were happening for the market to rise. Those good things are getting stronger next year, Zach. Like profit margins are going to recover strongly. We should get a pretty big PMI boom. I think consumers are going to feel a lot of relief once we vanquish COVID. And if interest rates remain low, which we expect, then you're talking about a big negative rate environment while GDP is growing. And finally, the VIX, which you kind of mentioned, could fall even into the 17, 16 range. This really is great news for stocks. But I do think it's like 2020, it could be really tricky. And I think in the first half, we might make our way towards like the 4,000 level and then fall back to 3,500. And of course, you got to be ready to take advantage of that because that's not the end of the bull market. It's just the pause that refreshes.
There seems to be a key qualifier in there, though, that once we vanquish COVID, which is something that hasn't been done. Obviously, you look at a place like California, we've seen a significant uptick over the last 48 hours or so with hospital capacity now at 0%. When you look at where things stand right now, how much of this thesis that you've put forward is contingent on 75% of Americans getting vaccinated, as Dr. Fauci has said, that's needed for activity to resume to pre-pandemic levels?
Yeah, foremost, COVID's unpredictable. So, I have not been able to find a good way to forecast it, and we have not. And so to me, it is completely unpredictable. So you're correct. That's the biggest risk. But we also know that if you implement a strict lockdown like Europe just did, COVID rolls over hard. So, I mean, it's not like the U.S. doesn't have options. Listen, you can't ignore what Fauci or Gottlieb say. These guys are experts. But one thing to keep in mind, it looks like if you tabulate the infections in the U.S. so far, plus make some assumption about unreported cases, we're already, we could be as close to 25 or 30% of Americans have been infected by the spring. And so then if we vaccinate another 30%, which is about 100 million, and that's a lot, that would be over what the threshold is considered for herd immunity. So I don't know, and I'm not an expert. And I think if we have a correction in the first half, it's probably because of all these unknowns that you and I just discussed. I mean, I don't know what COVID's doing, and it's still the dangerous virus. So I think everyone has to be careful.
Yeah, and Tom, I mean, to Akiko's point there, it's a big question mark. But when you look back historically, and we showed the chart here in terms of what to expect, we saw a run up here, 63% since those March lows. But when you look back at history, you're looking at a few years there in 2009 to 11, as well as back earlier in the 80s. So what does that kind of indicate in terms of maybe what investors should be braced for if we do get a bit of that correction in the first half?
Yes, I mean, the first thing I think to keep in mind is, it's going to be really healthy for stocks to get turbulent, but as we go through it, it's going to be terrifying. I mean, if we go down 15% or from 4,000 to 3,500, 500 S&P point decline, it's going to feel like calamity. And people are going to be raising more cash. And there's already $4.5 trillion of cash on the sidelines. So you can imagine a lot of people who've been sitting on the sidelines are going to say, like, I'm putting like a vault, a force field around this cash. So you're going to talk about skepticism really growing. But that's how stocks can stage an even bigger rebound in the second half. So I think it's going to be healthy. It's going to be really scary. I wouldn't, if I'm long-term focused, I wouldn't be a seller. But if I'm tactical, or if I had a ton of gains and then January we see S&P 4,000, maybe it's good to, have some dry powder. And, just another thing I'd point out, I mean, the expansion is going to be strengthening next year. So I think that the fear of calamity should be mitigated by the fact that we'll have more visibility.
Tom, when you look at the sectors you're overweight on going into next year, energy, one of those, and I am curious how you're looking at that space right now. Is it about the renewables or the clean energy on the expectation of more aggressive climate policies being put forward by the Biden administration, or is it more about tracking the bounce back as we anticipate the economies to open back up in a more significant way?
Yeah. Well, foremost, energy is our long shot top three. So we have three sectors we like, but energy is, I think, our longest shot. Maybe a bit, not a dice roll, but the one that you have to realize it could be the diciest. But I think it's a bit like cable or how wireless recovered. Energy has the supply and demand dynamics, and supply was a problem the last couple of years because so much drilling, and that's going to be slowing. And then in 2014, 2016, when the industry had financial trouble, there was all this private equity money that came in. So there was too much capital, but that's not coming in anymore. So you have two constraints on supply. And then demand should improve next year because of the recovery. And so you have a real improvement in supply demand. So less bad, as Tom Luddy, who was essentially CIO of JP Morgan Asset Management, always said, less bad is good. I think that's happening with energy, and that's kind of how cable and wireless really came out of their bottoms. So it's more the carbon energy that could do well. But it's a dice roll, not a dice roll, it's the wrong word. It's not as clear cut as being long industrials or consumer discretionary.
Yeah, you've been pretty clear on your last appearances here. You like those epicenter stocks, as you talked about, some of those that have been most hard hit, whether you're looking at the restaurants, the casino stocks, the airlines, as well as some of the other ones you've highlighted there. But let's talk about another, let's continue the term of dicey roll here, because I think this one, I think we could both agree, perhaps a little bit dicier when we look at crypto. I highlighted a lot of the things you were right on there just to give the appearance of being fair here. There was one call when we chatted back in 2019, we were talking about Bitcoin maybe potentially reaching 20,000 to 40,000 by the end of 2019, maybe a little early on that one, but we're there now. So what does the crypto outlook look like to you, and how investors should maybe be looking into the momentum that Bitcoin has behind its back?
Yeah, Bitcoin, if I had to say 2020, what has it brought? It's brought more relevance for digital currencies, because these are free from interference from government. They are fixed in supply, so they are not, hurt by central bank liquidity. And it's a way for people to protect assets, because I think there is a lot of insecurity about how safe the world is. So that's why we've seen some financial institutions and some really smart commodity and macro investors get involved with Bitcoin this year. I think it's really validated what the fringe would have always argued, that this is eventually going to be an allocated asset. We've always recommended 1% to be allocated to Bitcoin. I think it's too low. It needs to be a higher percentage. But 2020 returns are a lot like 2016. And that happened after the halving. So I think 2017, which was the year Bitcoin last went a little crazy, 2021 would be the year where you might see that in Bitcoin. So if anyone is interested, it's still quite early in Bitcoin, because 2017 the returns were astronomical for crypto.
I'm not saying it's going to 40,000. No, you're still is that still the target though, to keep eyes on 40,000 being the top?
Well, I think that the easiest way for people to think about the upside for Bitcoin is its displacement of gold. And gold is, 7 to 9 trillion dollars of just above ground supply. And so that would put Bitcoin well above those levels. It's, a lot higher.
Okay. We'll check in with you to see where those targets stands. Although Bitcoin today below that $23,000 record it set yesterday. Tom Lee, it's always good to talk to you, managing partner and head of research at Fundstrat Global Advisors.